Warren Buffett's company, Berkshire Hathaway, effortlessly earns over $1.6 billion annually in dividends just from two companies, Apple and Coca-Cola, without lifting a finger. Many people believe that dividend investing is a safe and reliable way to generate passive income. But that's only half the story. The truth is, dividend investing can be risky business if you don't know what you're doing. I'm a chartered accountant from UK and head of accounting at a Fortune 50 company. Over my 12-year career, working with dozens of millionaires, I have studied how the rich invest, and buying stocks myself, I have learned what works and what doesn't. In this beginner-friendly video, I will teach you all you need to know about dividend investing. Let's jump into it. Now, I'd like to tell you a story, which I of course made up, to help you understand how dividends work and why they matter in the real world. Once upon a time, in the bustling city of Investorville, there was a family-owned pizza shop called Penny's Pizzeria. Penny wanted to grow her pizzeria into a nationwide chain. To make this dream a reality, she needed money, but didn't want to take out risky bank loans. Instead, Penny decided to sell small pieces of her pizza business to people who believed in her savory vision. She determined her business had a net worth of $500K and cut her business ownership into 100 equal parts or shares, each worth $5K. These shares or slices of ownerships are called stocks. Penny placed an ad in the local newspaper's business section where investors could buy and sell shares in companies similar to the real stock market. This caught the eye of Penny's regular customer Sam. Excited about the opportunity to invest in his favorite pizzeria, Sam purchased 2 shares for $10,000, giving him 2% ownership or shareholding of the business. After the first year, the business made $10,000 in profit, and as a shareholder, Sam received a $200 check as his share. This payment to shareholders from company profits is called a dividend. The percentage of the dividend payout compared to the Sam's original investment represents his dividend yield. In this case, 2%. In the real world, companies that pay dividends are like most reliable pizza places. They have plenty of cash and great recipes. They also focus on quality measures like good cash flow, keeping their debt low, and high profits. Now, did Sam hold on to his great investment in the business for the long run? More on that towards the end of the video. Now that we've covered the core concepts, there are a couple of important things to consider before you start investing. Educate yourself. Abraham Lincoln famously said, "If I had 5 minutes to chop down a tree, I'd spend the first 3 minutes sharpening my axe." Investing is a lifelong learning process, so it's important to learn more before making any investment decisions. You can find many helpful courses, articles, podcasts, and videos, like my channel of course, that can help you sharpen your mind about investing. Number 2, learn how to read financial statements. Financial statements are like a report card on a company's financial performance. They show how much money a company is making, what it owns and owes to others, and how much cash it has. It's the first thing I read when researching about a stock. Knowing how to read these statements will help you make informed investment decisions and understand the risks and rewards of investing in dividend-paying stocks instead of relying on news or tips from friends. Let me know in the comments if you'd like me to make a video about how I assess stocks before I make an investment. Number 3, focus on quality. Choose stable, established companies with a long history of consistently paying and raising dividends. Avoid high yields from risky companies. Companies like Johnson & Johnson and Procter & Gamble are dividend aristocrats and worth considering. Dividend Aristocrat is a company that has raised its dividend for at least 25 straight years. I personally only invest in companies I understand, align with my personal values, and have debt less than a quarter of total assets, as high debt can cause a lot of problems. Next, diversify your holdings. Don't put all your eggs in one basket. Spread your investments across different stocks in various sectors to reduce risk. Next, compounding. Reinvesting dividends for compounding is like planting a seed that grows into a tree. By reinvesting your dividends and buying more shares, your investments grows over time. This compounding effect accelerates the growth of your investment, allowing it to multiply exponentially. For example, let's say you own 100 shares of a dividend-paying stock. Each share pays a $1 dividend annually. If you reinvest those dividends, your number of share increases. As the number of share grows, so does the amount of dividend you receive. This compounding process can significantly boost your investment returns. Next, take the long-term view. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." Think long term and be patient. Dividend investing works best as a patient buy and hold strategy. The compounding really shows its strengths over decades. Build positions gradually over time, even with a small initial investment, to manage volatility risk and get better average entry prices. My first investment was a mere £25. Payout ratio. Payout ratio is the percentage of earnings that the company pays out as dividends. For example, a payout ratio of 90% means that 90% of the earnings are paid out as dividends and only 10% is reinvested into the business. A ratio of 30 to 50% is generally considered healthy, while anything over 50% could be unsustainable. A high payout ratio may indicate that a company is paying more than it can afford. Now, dividend investing is not for everyone, and whilst it provides stable long-term wealth building, there are other investing strategies which may better align to your goals, and you should consider them. First, growth investing. Let's go back to Sam. He had invested in Penny's Pizzeria as he could see the potential for the business to significantly grow quickly into a nationwide chain. Fast forward 10 years, it now had 10 branches across the country and the business was worth $5 million. Sam's 2 shares were now worth $100K. He benefited from the increase in the value of the business. Penny did not increase the dividend payout over this time and continued to reinvest a lot of the profits for the business growth. Growth investing involves buying stock in companies that are expected to grow quickly with the goal of selling them at a higher price in the future. Second, value investing. Value investing can be compared to shopping at a sale. Imagine you find a high quality item that is on sale for a much lower price than it's really worth. You realize that the market has underestimated the value of this item and believe that its true worth will eventually be recognized. So you decide to buy it with the expectation that its price will go up over time. Similarly, value investing finds undervalued stocks that are trading below their true worth and holding on to them and waiting for the price to increase to reflect their true value. Number 3, real estate investing. This involves buying properties for rental income or selling them at a higher price in the future and is a great strategy to explore if you have that level of funds. And number 4, the ultimate best investment you can make is in yourself. You are your greatest asset. I can guarantee it will pay the highest dividends and capital growth at the same time. I personally have a £150 monthly budget for my own learning and development. I consistently invest time learning new things, which I love to share on this channel with you. I believe investing in AI skills and knowledge is one of those skills that will create millionaires and provide long-term success in the next couple of years. You might want to watch this video where I talk about 6 AI tools to make money and save time.